Hello and welcome back to Wall Street Training's complex leveraged buyout modeling. What we will now do is direct our attention to the debt sweep, in which we will add on and layer on top of our existing debt schedule that we have built from our core standalone projection model, to which we will now add the new additional tranches of debt that we raised through the LBO summary. Here now we will appropriately capture the correct tranches as well as sweep and flow through the cash appropriately. Again, the revolver will be our ultimate balancer, keeping in mind that we had made sure that the revolver balance could never go negative through that max zero function that was wrapped around our min formula in the sources and uses of funds on our revolver in the LBO summary page. Therefore, we should still be good now in terms of making sure the model continues to flow. What we will now do is also take a look at our term loans, in which we will add a new row, discretionary payments on the term loans, that says if there's any excess cash that's built up still, let's use that cash and also pay down our term loans as fast as we can. So now let's direct our attention to cell I-11 on our debt sweep. And I would like you to check for me I-11 is correct, that it includes the mandatory debt repayments for all of our existing tranches as well as our new tranches. This is something that we should have already built in, again, in our core projection model. So let's just quickly check to make sure. In cell I-11, mandatory debt payment, you want to make sure it says I-17, term loans, I-24, senior notes, 31, tranche 1, 37, tranche 2, 44 for sub-debt, and your preferred will be row 51. Please make sure that's row 51 and not the ending balance. Now what I would do is we should be all set there. So let's go ahead now and direct our attention to cell H19. Again, this row 18, discretionary debt repayment, we'll do at the very end to make sure we understand the logic there. So we're going to leave that blank for now. So let's go to H19. And in H19, what I'd like you to do is grab in the ending balance from your LBO summary. This is your pro forma capital structure. H19 will be equal LBO summary, and you're going to grab that from column V, our capital structure. Capital structure, column B. We want our term loans on top. Why is that on top? Because that will be the first thing to pay off. That will be the most senior, so to speak, because there will be an amortization assumption on that. So now, what is the amortization assumption? Go to I-14. As we have mentioned, when building the sources and uses, the term loan, typically, in this case, we only did one term loan. There might be three layers, A, B, and C. And here you're going to have mandatory principal repayments on a scheduled basis, not a bullet payment, because this is bank debt, bank loans, as opposed to a corporate bond. So I-14, let's quickly grab in and say equals 1 divided by the term. This will tell us the percentage of the initial ending balance, H19, that we will have to amortize mandatory payments. So I-14 equals 1 divided by, control page up a couple times, bunch of times to the LBO summary, and I want you to grab the term of the term loan, which is going to be cell Y19 on the LBO summary, and hit F4 for me there. So again, 1 divided by LBO summary Y19. Now what I'd like you to do is as follows. In cell I-15, I want you to grab for me the mandatory repayment amount that we must make at a minimum. So I-15 will say equals H19, and here I need you to hit F4 function key. Why am I going to fully lock and hard anchor H19? Because that is the amount that you will now take and multiply against I-14, your 16.7%. What this means is you must make at least a $333 payment every single year. If you didn't lock in this H19 in your cell in I-15, then as you copy this to the right, it will continuously say, give me 16% of the previous year's ending balance. But that's not the case here. We have to fix the amortization. It's as if you borrowed $100 in a 5-year loan, you have to make $20 every single year. So it's off the original balance, because this balance obviously will continue to decrease as you pay it. So what's my beginning balance in cell I-16? Our beginning balance in I-16 is simply going to equal H19, our last year's ending balance. In our mandatory payments, normally I might just say equals negative, that's $333. But keeping in mind that we have a row 18, which we'll build later on, if we have any excess cash flow after we've paid down all of our previous existing debts, except for the revolver, because the revolver is going to get paid last to maintain flexibility, pay down the term loans first. What we're going to say here is, take that back, we're going to pay the revolver down first to make sure that only if we have excess cash left, then we'll pay down a term loan. This will allow you to maintain flexibility by paying down your revolver first and freeing up that potential quote-unquote line of credit. So if you need to have a sudden cash need, you can borrow upon your revolver. Because once you pay down the term loan, you will not be able to borrow back from that specific item, that specific term loan, whereas the revolver, thinking of it as a credit card for the company, so to speak, will be accessible to you if you need the cash. So therefore, because also now, if we had excess cash built up after we pay down the revolver as well, we're going to have to come back here in this row 18 and say, well, hey, listen, go pay off as much of this term loan as you can if you can. If you are prepaying any amount of your term loans through the discretionary sweep after everything's said and done, your balance, your beginning balance will be lower. So if it turns out that you no longer have to pay, you only have $100 of beginning balance now, and you're telling yourself, pay the $333, you're going to get a negative number here. Don't pay off more than you owe. So here in I-17, I'm going to give you a new formula. You're going to say equals negative minimum of the beginning balance or the amount that you have to pay. Very similar to the revolver's formula that we had done last time. Again, you're going to pay off whatever you owe, the $2,000 or the mandatory of the $333. That's the minimum payment. If you only owe $100, it'll take the $100. It won't take the $333, and therefore your formula is not going to be good. Right now, since you still have a $2,000 balance, we'll see how these numbers flow through later on. You only have you have a full $2,000 balance. Pay off at least $333. We're going to leave row 18 blank for now. We're going to come back to this after we've all the numbers in here so you can see how it works. And I want you to, at this point, take an alt equals. Alt equals gets you to cell to the left because there's nothing on top. So I want you to now please make sure in cell I-19 you say equals the sum of I-16 through I-18, your beginning balance, less your mandatory, and of course later on we build in our discretionary sweeps, discretionary payments. So now in cell I-20, I want you to say equals average, open parentheses, of the two cells right there, H19 through I-19, take the average of those. And of course, I want you to take everything here from I-20 all the way up to I-14. And guess what we're going to do, folks? What we're going to do is we are now going to say shift right control R to column M, 2009. And now you're saying that at the end of 09, because this is a 5-year model and you have a 6-year term, you still have $333 left at the end. And that, of course, should make a lot of sense. We'll later on see that around 2008, this amount will actually go to zero at the end of 08 because we will have built up enough cash or enough payments have been gone that we now have the ability to actually prepay our term loans. So what I want you to do is let's quickly go ahead